Without money, a man is unnecessary. This phrase reflects a harsh reality in the world of finance, especially for traders. Success in the stock market relies not only on capital, but also on the proper use of knowledge. Inventory levels in companies' financial statements are a critical tool for understanding this knowledge. Changes in inventory carry strong signals that indicate opportunities and risks. In this video, we explore how inventory changes affect stock prices and how traders aiming to make money can leverage this information to their advantage. Factors that drive stock prices up. 1. Increase in demand. An increase in demand arises when customer interest in a product or service grows. Companies rapidly deplete their inventories to meet rising demand, leading to a significant boost in sales revenue. For instance, the launch of a new tech gadget can create a surge in demand, causing the company's stock to sell out quickly. This scenario enables the company to generate higher short-term revenue and improve profitability. Increased sales and strong financial performance elevate investor expectations, driving stock prices upward. 2. Technological advancements. Investments in technology make inventory management and logistics more efficient. For example, a company utilizing an AI-powered inventory management system to increase inventory turnover can reduce excess stock carrying costs and optimize working capital. Such innovations help companies lower costs and improve profitability in the long run. More efficient operations and cost advantages play a critical role in driving stock prices upward. 3. Seasonal demand increase. At certain times, demand for products naturally rises. For instance, the holiday shopping season, increased demand for tourism products in the summer, or back-to-school stationery sales are typical examples. During such periods, companies rapidly deplete their inventories to meet growing demand, often selling at higher profit margins. Strong seasonal performance boosts investor confidence in the company, leading to upward movement in stock prices. 4. Competitive advantage. In competitive markets, companies that can respond quickly to customer needs and manage their inventories effectively gain an edge over their rivals. For example, a textile company having a popular product in stock during a surge in demand can secure customer loyalty. This strengthens market share and enhances financial performance. Companies that effectively capitalize on their competitive advantages often see an increase in their stock prices. 5. Economic recovery. During periods of general economic growth, increased consumer spending power positively impacts company sales. In this process, inventories are rapidly depleted due to rising demand, leading to higher company revenues. Economic growth has a particularly noticeable effect on stock prices in sectors such as construction, automotive, and technology. Investors take a more optimistic view of companies' future potential, increasing demand for their stocks. Factors that drive stock prices down. 1. Decrease in demand. A decline in demand can result from economic stagnation, changes in consumer behavior, or increased market competition. This leads to stockpiling of inventories and a slowdown in cash flow. For instance, a drop in demand in the fashion industry can leave stocks unsold, forcing companies to sell at a loss by the end of the season. Such adverse situations weaken profitability, causing stock prices to fall. 2. Production and supply chain issues. Disruptions in production or breakdowns in the supply chain can cause significant problems in a company's inventory management. For example, a global raw material shortage might halt production and deplete inventories. In such cases, the risk of being unable to fulfill sales can lead to a significant drop in stock prices. Additionally, these issues negatively impact customer trust in the company. 3. On price increases and inflation. Rising costs of raw materials, energy, or logistics increase inventory expenses. For example, a surge in oil prices raises transportation costs, making products more expensive. When companies cannot pass these increased costs on to consumers, their profit margins shrink, which negatively impacts stock prices. 4. Economic recession or uncertainty. During periods of economic slowdown, reduced consumer spending leads to stockpiling and a slowdown in cash flow for companies. For instance, during a global recession, demand for high-priced items like cars or luxury goods may decline. This negatively impacts company revenues and investor confidence, causing stock prices to drop. 5. Seasonal demand decline. A seasonal drop in demand for products can lead to unsold inventory. For example, reduced demand for summer clothing during the winter season increases stockholding costs for fashion companies. This lowers profitability, causing stock prices to decline. 6. Government policies and regulations. Increased tax rates, import bans, or the removal of incentives can raise a company's costs. For instance, an increase in import taxes can elevate the cost of raw materials needed for production, driving up inventory costs. Such situations reduce profitability and have a negative impact on stock prices. Understanding the intricacies of inventory fluctuations in financial statements provides traders with valuable insights into market behaviors. By identifying changes in inventory levels and their impact on stock prices, traders can turn challenges into opportunities. Success in trading is not about predicting the future, but effectively responding to real-time data and trends. Equipped with knowledge of these critical factors, traders can navigate uncertainty more effectively, make informed decisions, and confidently capitalize on market movements.